Hello everyone. NIO targets profitability by 2026. Are the risks worth the potential rewards? Let's break it down. NIO just released its latest earnings report, and it's a bit of a mixed bag. There are compelling reasons to both buy and sell NIO stock right now, and in this video, we'll go over both sides of the argument in detail. Let's start by discussing the reasons to buy NIO stock. One of the most reassuring things that NIO has confirmed is that, despite their reported losses of $700 million in the latest quarter, they do not foresee any need for further stock dilution. This is a significant piece of news because dilution often causes concern among investors, as it can reduce the value of their shares. NIO's management has stated that they won't need to issue more shares unless the stock price skyrockets. So, unless there's an extraordinary rise in stock price, there's no need for additional dilution in the near future. This news is certainly a positive for anyone considering an investment in NIO. Another reason to be optimistic about NIO is their profitability target for 2026. While it's always difficult to predict future earnings with certainty, NIO has set a clear goal to become profitable by 2026. Investors will need to have the patience to hold their shares for the next 2 years, but the potential for significant returns is there. 2 years may feel like a long time, but NIO is moving in the right direction. As their margins improve, profitability becomes more likely. Speaking of margins, NIO has confirmed that they expect margins to improve significantly in the coming quarters. In Q4, NIO expects its margins to hit 15%. And by 2025, the company is targeting 20% margins. Higher margins are critical for long-term profitability, and NIO is clearly heading in the right direction. While NIO's smaller competitor, ONVO, is still in the early stages of ramping up its production, it too is moving toward higher margins, which bodes well for the future of both companies. As both companies continue to optimize their production processes, their margins should continue to grow. If you're looking at NIO from a long-term perspective, it seems clear that the company is making the right moves. If you buy NIO stock today and can wait for 2 years, it's highly likely that your investment will pay off. Sure, profitability isn't guaranteed, but everything points to the company heading in that direction. Over the long haul, NIO's growth prospects seem promising, especially as they ramp up production and expand into new markets. Now, let's flip the coin and look at the reasons some investors might consider selling their NIO stock. One of the big challenges NIO is facing right now is order cancellations for their ONVO model. The company reported that between 50% and 60% of ONVO orders are being canceled, and the primary reason for this is the timing of deliveries. Customers who ordered ONVO vehicles want to take delivery before the end of the year, in order to take advantage of local subsidies. If NIO can't deliver the cars on time, customers are choosing to buy from other companies that can deliver before the end of the year, such as Xiaomi or XPeng. This puts pressure on NIO to ramp up production quickly to avoid losing customers to the competition. Another potential red flag is the company's increased spending on SG and selling, general, and administrative expenses and R&D research and development costs. NIO has stated that these costs will rise in Q4, as the company continues to expand its store network and invest in new vehicle models, such as the NT 3.0 cars and the Firefly brand. While expanding stores and developing new vehicles is crucial for long-term growth, it also means more short-term spending, which could lead to bigger losses. In Q3, NIO reported losses of $700 million, and if their spending continues to increase in Q4, it's possible we could see losses grow to $800 million, $900 million, or even $1 billion. This could put downward pressure on the stock price and cause some investors to reconsider their positions. Another concern for NIO is the potential decline in vehicle deliveries. The company's upcoming third-generation platform will likely lead to more expensive cars, as models like the ET9 and ES8 will be priced at a premium. Additionally, NIO is expected to phase out the ET5 and ES6 models to make room for the ONVO series, which will target a more premium market. While ONVO vehicles are expected to sell well, particularly the L70 and L80 models, which are larger SUVs, the transition could result in a dip in NIO's overall delivery numbers, especially if their lower-priced models are discontinued. If NIO sees fewer deliveries in the future, it could be a sign that their strategy isn't as effective as anticipated. As NIO expands into the electric vehicle market with its Firefly brand, it will need to build out new infrastructure, including smaller, cheaper swap stations. While these new stations are less expensive than NIO's current ones, they still represent an additional cost that NIO will have to bear. If NIO doesn't build a sufficient network of swap stations, it could limit the success of the Firefly brand. Firefly's success hinges on the ability to offer a strong network of charging and swapping stations, and if NIO fails to establish this network quickly, it could hinder Firefly's growth prospects. While NIO's long-term growth story looks promising, the short-term outlook could be more difficult. In the immediate future, the company will need to spend heavily on new infrastructure, vehicle development, and marketing. This spending could result in more significant losses in the near term, which could lead to downward pressure on the stock price. If NIO's Q4 earnings report shows higher than expected losses, investors might decide to sell their shares, leading to a decline in the stock price. To sum it up, NIO presents both an opportunity and a risk. On the one hand, the company is on track to become profitable by 2026, and its margins are improving steadily. If you're able to hold your position for the next couple of years, there's a good chance that your investment will pay off. On the other hand, there are significant challenges ahead, such as production ramp-up issues, rising costs, and potential declines in deliveries as NIO shifts its focus to higher-end vehicles. If you're looking for a short-term play, NIO might not be the best option, but for those willing to take a longer-term view, the future could be very bright. The key takeaway is that while NIO's short-term outlook is uncertain, the company's long-term prospects look solid. By 2026, if everything goes according to plan, investors could see a strong return on their investment. However, in the short term, we may see more downward pressure on the stock price. It's up to you to decide if you have the patience to wait for the rewards. Thank you for joining us today. If you enjoyed the video, don't forget to hit the like button and subscribe to our channel for more stock predictions and market insights. Remember to turn on the notification bell so you never miss an update. Happy investing, and see you in the next video.